I'm joined today by Mr. Paul Nixon, who's the Head of Behavioral Finance at Momentum Investments, and we're tackling an interesting topic. We're talking today about technology and understanding our behavior using technology. And I've got Paul here this morning to help me unpack all of this. Good morning, Paul.
Good morning, Chris. Thanks for having me.
So, Paul, explain this dynamic to us, please.
So, Chris, I think the question here is really, can technology solve everybody's problems? So I think in the 90s, everyone was talking about websites. And if we built a website, it was going to solve all the business problems, and we were just going to get sales that would sort of come through the door. Now everyone's talking about the metaverse. So all we need now is to put on a headset, and that again, sales are going to come. But of course, that's not really the way it works. So technology is actually a great way to leverage the skills that we have, but it can also expose us. So we have to make sure that the business fundamentals are in place, and then technology can be used to scale and leverage that. But in a behavioral finance context, I think technology is very interesting. Well, particularly to me, to see if it can help us understand financial decision making a little better.
So Paul, explain to us, this is getting a little bit technical, I would imagine, but how do the two work together? How does machine learning come into play? How does this all fit together?
So look, machine learning is a very useful technique or technology to help us unpack a lot of data. So when we have, for example, a lot of switching behavior, now that's one of the problems that we've identified at Momentum Investments, is how do we keep people invested? So we've seen that people have a problem. They tend to, their preferences change, or their perceptions of risk are changing all the time, and they're moving money around to try and get out of the way of a crisis, or to try and take advantage of the next the next big trend. So one of the behaviors we've identified is how do we keep people invested? How do we stop them from switching? And machine learning can help us here because there's a lot of data over a number of years, and machine learning can help us here to identify any patterns in the behavior. So pretty much what it's doing is there's an algorithm at play here that is trying to look for patterns of risk behavior, and that's really the crux of that.
So we've always we've heard the story. There's this revolving door at the JSE, and people run in and out of it at the wrong time. Obviously driven by various things: fear, greed, not understanding. Does your analysis pick up on what sits behind those sort of decisions, and what happens in that process? How do you guys analyze that?
Yeah, so exactly the same relationships came through, Chris. So we saw when we looked at the algorithm and we set the task to the algorithm of identifying behavioral patterns, we saw that from 2006 to 2021 there were four quite prominent behavioral patterns that were all statistically significant. And if we briefly unpack these, we can see that the first one was risk-averse behavior. So we call these people the avoiders. So people who just didn't like taking investment risk at all. So they invested the most conservatively, and they kind of just got stuck there. So these people pay a behavior tax, which is slightly different because they stay in, that inflation is their biggest enemy in this case, because they stay in conservative assets for a little bit too long. On the sort of moving to the next pattern is loss averse people. So loss aversion is different to risk aversion. So people who are loss averse don't mind risk, but at the first sign of market volatility, they de-risk their portfolios very quickly. And this group of people paid by far the biggest behavior tax in 2020 when markets crashed. So they ended up selling out very, very close to the bottom of the market at 37,000 points, and then they scrambled to get back in a market recovery that only took 3 months. Then the next group were the assertive. So this is almost on the other side of the spectrum, people who are overly aggressive. So people who are up-risking their portfolios, least likely to take investment advice. People who are overconfident, who have their own theories, and they kind of stick to them. And the final one was the market timer. So those are the people who are greedy when others are greedy, fearful when others are fearful. And in 2021, they destroyed by far the most amount of value because markets were going up and down, and they were tending to, exactly as your analogy presents, they were almost sort of in the wrong place at the wrong time. So those were the four patterns of behavior that we would more or less expect. But it's interesting when you use machine learning, you actually see this stuff coming to the fore in actual observed behavior. And excuse me, that's really the power of machine learning, is that it can show you actually what people are doing, and people are destroying value at different times as well. So you can start this whole powerful exercise of segmentation. So talking to the right person at the right time with the right message.
Right. And in a practical sense, I mean, how do we then apply, that in the investment environment? When addressing that problem, I mean, does one speak to individuals? How does that come into play?
Yeah. I mean, that's a good question, Chris. I mean, if you look at machine learning, traditionally techniques using machine learning don't really have a time stamp. So for example, when you use machine learning to analyze behavior, let's say from 2006 till 2021, that means that you're going to get an average or a pattern, right? But it's an average pattern. So, the problem with that obviously is that, I mean, if you look at the example, I mean, the famous example, Ozzy Osbourne and Prince Charles were both, born in the same year, both live in a castle, both rich, but they're very different people, right? So that's the problem with averages, So there is that limitation to using machine learning. However, it's the first step in a process. So once we have the 4 behavioral patterns, we can then start looking at human beings in those patterns and trying to sort of see, how closely they match. And also developing then sub-segments in those patterns to develop a more personalized approach to engaging people. So machine learning is not the answer, but it certainly is a step in the right direction of engaging different people, at the right times with the with the right messages.
All of this stuff is fascinating, and all the theory and information that one gathers. I think you guys are sitting with immense amounts of data, and you can obviously develop a lot of these patterns and things and see where they're going and different types of people. How does that then practically translate and land on the lap of that specific investor, and then as to change or not change their behavior going forward, obviously then to their either detriment or to their advantage?
So, if we think about the factory settings that we come down with, or the personality traits that have been shown to come down in our genetic code, those are our factory settings, but the environment tends to moderate those factory settings, and then we get the set of behaviors and characteristics that makes Chris or Paul, and those are our personalities. So psychometric data is, I think, going to be the next form of big data, because it's going to enable this hyper personalization. So if you think about that from when you watch the Barclays Premier League, the advertisements that we see now on TV are different depending on our location. So we could also think of a world where the advertisements we see are different depending on our personality settings. Some of us like emotive messages in adverts, some of us don't like that. So where it becomes particularly interesting is where we start looking at psychometric data, and we tie that, or we start looking at ways to tie that to the behavioral patterns that we've uncovered from machine learning. So we can then start to look at even reversing personality or psychometric traits out of machine learning data as well. So that gives us another avenue to start again this hyper personalization strategy or approach that really is going to make these messages, or give us a better chance of these messages landing in front of the right people at the right times. Right. And that's the most important thing from an investing perspective, right? Is your perception of risk changes. That's very time dependent, because markets go up and down. So we need to know who you are at that point in time and how you're likely to react. And that really gives us I think a lot of ammunition to start approaching this problem of people making these decisions, both advisors and clients making the wrong decisions at the wrong times.
Fair enough. And I think it also empowers the individual, obviously, to then adapt their sort of, knee-jerk reaction, what it would have been, to a much more sort of thought through approach and doing the better thing than just be a reactive thing. Fair enough. Okay. So, Paul, I mean, this stuff is really interesting, and so one obviously has to think, what about the future? Will AI and machine learning and things like that come into play 100% in, say, something, for example, the investment field? Where does that leave the humans? Are these things going to run autonomously and make decisions and calls on certain investments and leave us out of the equation? Where do you see this going?
Yes, I mean, I think a very good analogy, or not an analogy, I mean, it's actually a practical example, is probably, IBM's Deep Blue, when that machine beat Garry Kasparov, the very famous chess player in the late 1980s. I mean, I think the world sort of gasped as, it was the first time that machine had beaten man. And from there, people thought that, this was the first sign that we were heading towards this futuristic state of the Terminator, and then what the situation we all fear. We see sort of Arnold Schwarzenegger standing naked in the street, a bit of a robot. But of course, what happened from there, which was actually very interesting, was that later on, as sort of time progressed, they found that a human AI partnership called a centaur was unable to, that partnership was basically invincible. So the human centaur or the human machine partnership no machine could beat that partnership of man and machine. So luckily for us, we're both or each different at, or rather each good at different things. So, machines are very, very good at processing tons of sequential calculations in an instant, right? So the human brain still can't perform a pocket calculator from the 1970s. We can't do that. Our brains just don't work that way. But where the human brain is very, very good, though, is the strategy. So it's kind of where we're going with this, what's the 5-year plan? Machines aren't very good at that. They can calculate a lot of different iterations. So if you move that pawn there, I'm going to do this, then you're going to do that, then I'm going to do this. They're very good at that. They're not good at the general or the general strategy in the play of where the chess player is going. So because we're each good at different things, strategy and tactics, we see that humans, that centaur partnership, human or man and machine, is a very, very good way to go. So I think that certainly it appears that the man-machine partnership or human-machine partnership is going to be the way things are going, at least for now.
Fantastic. Fascinating stuff, and I'm sure we can still talk a lot about this, and I'm sure if I give you half a chance, you'll say, I'll be back. But that's been brilliant. Paul, thank you very much for your time. I really enjoyed our chat, and look forward to engaging with you guys more in the future. Thanks.
Super. Thanks, Chris. Take care.